All right, good morning, everyone. It is 8:31 on the morning of December 1st, 2022, and this is my pre-market strategy session. So right now this morning, if the Qs opened up, it would gap up by about $1. So there is a small gap here that's gapping up this morning. I imagine that at the open there's going to probably be here, let me just kind of go to the 10-minute chart here real quick. If I had to guess, which, you know, I'm going to guess. I don't have to do anything. But basically, what I imagine is going to happen is at the 9:30 bell, it's going to rise up, come back, close that gap, and then take off to the upside. That's my guess for the day. That's what I see happening. The Fed came out yesterday and was less hawkish. And so the market took less hawkish as more bullish. Well, the old saying goes, don't fight the Fed, right? And so in the meantime, the Fed is still hawkish. The Fed is still going to raise rates at its next meetings until it starts to see the rates match up with inflation, right? I think was the plan all along was to start tightening until inflation comes down and then meet, the Fed rates meet inflation in the middle somewhere. So what inflation at its peak was like somewhere around 8.5%, I think, year over year. So the plan for the Fed, the Fed doesn't have to raise rates all the way to 8% in order to bring inflation down. It just needs to start raising rates until inflation comes down to where rates are. So, yeah, looks like, the market is definitely happy about it. There's still some rough seas ahead. And I say that this is the 10-year, 2-year yield delta. And so here's the zero line right here. This pink line up here is the zero line. And so right now, the 2-year is yielding 734, just switched over, 737 basis points more. The 2-year yield is 737 basis points greater than the 10-year yield. So, very interesting. And what makes that very interesting is that every time back here in the late 80s, and then here's the 2001 crash, and then here's the 2007 crash, every time this yield curve starts to normalize again, we see equity markets crash. So it's still on the horizon. The big downturn in the equities and so on and so on is still on the horizon. Where exactly, and when exactly that happens, I'm not sure. And I really, other than just generally like money velocity slowing down, I don't really understand why there would be a crash. I mean, there's got to be like some really serious stuff happening to cause a crash. And right as of right now, the housing market isn't really in trouble. There might be some folks who go underwater who bought, during the COVID lockdowns. There are a lot of people who bought houses and home prices inflated significantly in that time period. I suppose, the possibility that we're coming into a period of time when there's going to be contraction in the workforce, and so unemployment is projected to go up. I suppose there could be a round of defaults on mortgage defaults. However, I don't think that it would be anything near the severity of the 2007 levels. Well, I don't know. It's all too much for me to get my head wrapped around. So I just trade the charts that are in front of me. And right now, as the yield curve is inverted and stays inverted, the markets can actually be bullish. This is a huge signal. This is a huge recession signal, and it predicates a significant downturn in equity prices every time that it happens. And I guess we're just gonna have to sit back and watch it play out. Whatever it is that's going to cause this giant downturn, it's on its way. But in the meantime, the markets can remain irrational longer than I can remain liquid. So I just got to do what the market's doing. Yesterday the Qs rallied 4.56% on the back of Jerome Powell's comments on becoming less hawkish and forecasting that CPI is going to come down, and that real rates, nominal rates, ought to at least match inflation rates. And that is good news. That is, there's no doubt about it. That is good news. When it comes to, don't fight the Fed, though, the Fed is still hawkish. So the Fed is still tightening. And so, I think eventually that means that there is going to be, more downside in the market somewhere. I don't know where. In the meantime, though, it looks to me like, let's get to the bigger picture here. Looks to me like we're going to test this upper limit, this support and resistance line here on the Qs, which if it did it today, it'd be around 306.19. I don't think it's going to do it today. Yesterday was an enormously powerful move. The only thing I think that's a little bit spooky is there's this gap down here. Let's see if I can get to the right horizontal ray. There it is right there. 267.76 is still going unfilled. And so that is going to get filled again at some point. The gaps eventually always get filled. I thought it was going to be sooner rather than later. Maybe now it's going to be later rather than sooner. So if we start taking off to new all-time highs here, you can expect the next crash to bring it down to 267.76. All right, everybody. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell, and I'll see you at tomorrow morning's strategy session. I am out.